President and CEO of Gerber, Kawasaki Wealth and Investment Management. Ross, nice to have you with us. Thanks for your time.
Thanks for having me.
Let's talk about how you're viewing this all-important week in the tech sector. You got Apple and Facebook's parent and Google's parent. I could go on. But what are you really looking to walk away from all of these companies as they report?
Well, mostly I'm most concerned just globally on what's happening in China. And we know that it's affecting the hardware side of many of the tech companies' business like Apple. And we're just not sure how much and how long this effect will happen and how costly it will be, not to mention the secondary effect of the Chinese, what I'm calling recession, which is basically what they're in now, and the slowdown in spending that we're seeing in China, which also affects many of the tech companies, but not all of them. And so it's a really sort of boogeyman factor to earnings from what I think will be a very good earnings season for the tech companies, but it'll be very hard to see how these companies will perform over the next 3 to 6 months, which is a short-term issue, but because of China's failed COVID policies.
Right. Just so many different headlines that have been flying. Yeah. And, you know, you had this significant love affair among investors with technology. And now that we seem to be moving into a different market cycle, you have a lot of pundits who are not in favor of tech stocks right now, who build the case, look, we've seen this kind of scenario before. Not only have we seen weakness, you could see more weakness. Is there anything different this time around, Ross, from your vantage point after the selling we've already seen? I know not every tech stock is equal, but...
You know, we have this debate in my firm every 5 years when value has this brief moment, and it's usually because rates rise. And this happened, you know, a couple of years back when rates rose the last time. And there was this brief period where we talk about investing in Campbell's Soup and Mondelez, and it's just, you'll never make a lot of money investing in these stocks. They're just not growth investments. But then you look at the big cap tech companies, whether it be Google, Apple, or Microsoft, for example, and their dominance has never been greater. Their earnings have never been higher. Their growth rates are ridiculously high for their size of these businesses, and their dominance in monopolies and moats only gets bigger. So I think still to this day, if you want to make money over the long term, technology will always be the best place to invest for American investors in my mind, and what I've done my entire life. And I think the future is incredibly bright for technology companies, period, not just with the innovations that are happening, but also with the profits that they'll be generating from this. So I would not extrapolate out because oil is having a great run because of the Ukrainian genocide, that somehow value stocks are going to outperform these big cap techs over the next 5 years.
All right, helpful context there. And while we don't have time to go through every name in the technology area, just to give our audience a bit of a flavor of what you're more leaning towards right now, Apple, Microsoft, Google's parent Alphabet, these seem to be the ones that you're a little bit more receptive to right now versus let's say a Meta, the parent of Facebook,
right,
or even an Amazon. How come?
So in my fund GK, our top holdings include Microsoft, NVIDIA, Google, and Apple in the tech sector, including Tesla as our top holding. But these companies are really focused on areas that we're super bullish on, like AI and cloud, and the way their subscription models have made their businesses much more profitable and easy to analyze, along with the consumer sides of businesses like Apple, which is booming. Streaming is obviously and gaming still doing very well, despite people going out into the real world and maybe less attentive to streaming and gaming as they were 2 years ago, but certainly these are great businesses to be in. So we think these companies are in great positions, where companies like Meta, Facebook, which is really seeing a decline in the user engagement and growth because of the platform being so toxic, and people have moved to TikTok, and obviously Twitter and Snapchat are still doing very well. But we don't like Meta, and we don't like the approach they've taken, and we don't think they win in VR, which is where they've really focused the business in the metaverse, and they've done nothing in the metaverse. So I think they've got issues. And with Amazon, they've got costs and supply chain issues, and the fact that people are going to stores again. So a certain amount of their business is going to be lost as people go more to the omni-channel stores like Target and Ulta salons, for example. So we're less bullish on Amazon, and we don't like Facebook at all. But we're still very bullish on Google and Microsoft and certainly Apple.
All right.